Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carroll, Massar and Tim Stenovec from Bloomberg Radio.
We want to get to another story that was happening late Wednesday as well, and that has to do with one of the AI darlings.
Yeah, of course, we were talking yesterday about the departure of Chief Technology Officer Mira Murati, Chief Research Officer Bob McGrew. Then we've been hearing from Sam Altman from OpenAI as well, talking about executive departures at the startup being unrelated to a restructuring that's happening at the company as it considers moving to a for-profit structure. Bloomberg today reporting that OpenAI is discussing giving Sam Altman a 7% equity stake in the company as part of that restructuring. Let's bring in co-host of Bloomberg Technology, Ed Ludlow, who's in our San Francisco bureau, for more on this. Hey, Ed, great to have you back on. I mean, let's try and put all these pieces together, right? Are the executive departures, as far as we know, linked to the restructuring that's being discussed at OpenAI?
Yeah, we don't know. And Sam Altman, fortunately walked in front of a camera 12 hours after the news broke and had every opportunity to explain it. And he said no. They're relating to the individuals involved, their personal lives and their professional lives, and wanting to do something new. But I would say that, sources were very clear that inside OpenAI, which is a really important technology company, right? There's a lot at stake here. And the people that work there know that. And they saw what these people who decided to leave the company said. And in internal Slack channels and other comms tools were basically like, what is going on? Like, this is dodge. Like, this is weird. But the long and short of it is no, we do not know if they are linked.
We talk about OpenAI. The only reason I feel like we are talking so much about OpenAI is when you go back almost 2 years, right? And that big investment by Microsoft that got us all talking about and focusing on this company. Having said that, should we assume they're a big investor? Should we assume that what's going on now kind of has some consultation from Microsoft, or not necessarily?
Yeah. So this is actually an opportunity to clarify something that's really important. Microsoft is the single biggest investor into OpenAI at this stage. And at one time, it held 49% of the entity in which you could invest. But it probably is less than 49% now because of the additional rounds of capital that OpenAI has raised. And if I may, Carroll, I also would like to explain the structure of OpenAI as it stands. So its origin was as a not-for-profit, okay? And how it works right now is you have a non-profit, in this country, America, a 501c3, a charity. And the for-profit business is a subsidiary of that. And the way that OpenAI operates, and to answer your question, is that it now has a board who do not hold any equity at all. And that board includes Sam Altman. So there are two things that I'm answering here. One, Microsoft owns a pretty big chunk of it, therefore doesn't have a board seat. Sam Altman has a board seat, but if he's to own equity, it raises a question about him continuing to be on the board. And the whole mechanism was put in place because they didn't want the vested interests of shareholders to be competing with the mission statement of the company, which is more around building artificial intelligence that benefits society at large. Goodness, what a mouthful.
But how would that change if they did move to the public benefit corporation status? How would that mission be altered, apart from what you and colleagues have been reporting about, potential equity stake and questions over Sam Altman?
Yeah, again, I think it's really important to state we just don't know. I was on your show yesterday, you may remember, talking about Meta, and there was a Reuters report that OpenAI was moving to a for-profit model, was moving to a B Corp. And what happened was I was driving home from Menlo Park, I almost got to the Golden Gate Bridge, and a source phoned me and told me what was going on, but clarified that nothing legally has changed. OpenAI is looking at all kinds of mechanisms. So they haven't actually taken any action. I think the Reuters report probably went too far. But the B Corp instrument is interesting. The very basics of a B Corp are that you are a for-profit business. There are examples out there like Patagonia. I'm a Patagonia wearer, the apparel, you may be familiar with it. Mm-hmm. But in the bylaws of the company, the sort of lofty, big picture, worldly goals and missions of the company are codified. They're written down. So you can pursue profit, but you're also mandated to pursue those other goals as well, because they're in the bylaws of your company.
Well, first of all, thank you for reminding me you were the great reporter on Meta yesterday. I had forgotten. And secondly,
I haven't the glasses. I'm so excited about that.
And I'm just going to say OpenAI, every time we talk about it, I feel like it's just a great B-school case study because of just these twists and turns, the ousting of Sam Altman. He's back. Like, it's just unbelievable, and it ain't over. That's for sure. Ed Ludlow, you're the best. Co-host of Bloomberg Technology, joining us. Of course, you can catch that on Bloomberg TV, 11 a.m. Wall Street time, Monday through Friday.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, we are so looking forward to our next guest. He's got a great vantage point on the global economy, global mining, climate change. Just this past week, Fortescue, the world's fourth biggest iron ore miner, saying it will pay $2.8 billion to replace 2/3 of its fleet of haulage trucks and equipment in Western Australia with EV versions as it seeks to cut diesel consumption and meet ambitious emissions reduction targets. There's a lot going on.
Yeah, there sure is. And look, we've got a lot to talk to Andrew Forrest about. It joins us in studio, Executive Chairman and Billionaire of Perth, Australia, based Fortescue, in town this week during the UN General Assembly and Climate Week as well. Welcome to Bloomberg Businessweek.
Thanks, Steve.
How are you?
I'm on fire, thank you. I'm just in an exciting place right now.
It certainly is. And look, at a time that we're going to talk about your climate transition plan in a moment, because that's a really interesting conversation, we spent all week talking about China and the stimulus efforts being made there. And this is a story that's very central to your business as well. Imported iron ore used in roughly 80% of Chinese steel production. Talk to us about the picture that you're seeing of the Chinese economy from your side of the business and the demand. How bad is it?
Oh, how good it is. I mean, basically, you've had mining companies being fat, dumb and happy for a very long time because the iron ore price has been so good, so we're all heroes. But now, oh my God, the iron ore price has fallen, which means it's a lot better value, by the way, for the customer. And we have to work a lot harder as miners. We have to work harder to actually make a margin. And that's a good thing. And when people think that 1/3, they think, well, how do I lower my margins? Well, 1/3 of my cost is diesel fuel. 1/3, right? 1/3. Right. Imagine if we could get rid of that. Oh, by the way, we'd also be going zero emissions if we did that. So we've been working on this for years and years and years. And to give you an idea of how strong that demand is, because people are looking hard at their operating costs now, we took years and years to get up a 360 truck order. Now, these are big trucks, right? You've got the hubcaps starting at the roof here. And yesterday we signed another 100 and got walk-ins for another 400 in a day. So from 3 or 4 years for 360, for a day for another 500. So this is showing you that the mining industry is saying, hey, we've got to really look at operating costs. And Fortescue, admittedly, is driven because it wanted to go zero emissions, because we bloody well have to as a human race. But then we also have to prove that it's highly commercial. And what you're seeing happen yesterday and today is that going zero emissions is highly commercial.
To say you're not worried about China?
No, I'm not. I mean, I've just come from China, but I get accused when I'm in Chinese, when I'm in China, being very pro-North American. And when I'm in North America, I get accused of being very pro-China. So
no, but this is interesting because look, all of
I
the
know
narrative
you both
is
and love you both.
The narrative is so negative and has been for so long.
Are we wrong?
The slump in the property sector.
I'm afraid you're wrong. You are wrong. I mean, here in North America, you have a completely different system. You get lag effects and lowering interest rates and things like that, and it's macroeconomic policy, and it works really well over a long time. If they want to hit the accelerator, hit the brakes, you see the impact straight away. So they did a little bit of priming, not much. I've got to say, as a percentage of GDP, it'd be hard to measure it, but that has kicked investment straight away. It's kicked the iron ore price. It's kicked iron ore demand.
So 5% growth, not a concern. It's going to happen.
Look, I'm completely not worried about it. And by the way, if it's 4 or 6, I know big countries who'd love to get 2 or 3. So, for our demand, I'm seeing the iron ore price come down, and I'm saying good.
So Andrew, basically what you're saying is China's like, okay, if there still isn't enough, we're going to do more.
Yeah, and also, I love North America because we're aligned with North America. I love China because they're actually leading the world on going green. I mean, they are way ahead of their own plan. And, North America and China kicking the hell out of each other is really bad for the overall human race. This geostrategic war between North America, precipitated, I want to put it bluntly, by North America. And look, China does all these things wrong too, and you can jump on their toes, but you jump on their toes in private. You don't do it by shouting at them from New York or Washington, D.C.
Well, does that then worry you about who's in the White House come November? Because there is people who have a softer touch and people who don't.
Fortescue has a policy that we deal with any elected leadership that you suckers want to put up, right? So, if you want to put up Trump, I've got to say this Ukraine badge, if there's a deal cut which rewards an invader for invading a country, which you've had as an enemy for 80 years, and you go cut a deal and reward a bad guy for being bad, we're down in the Pacific and we're going to say, hold the phone. If you're going to trade Ukraine against Russia, where do we sit with North America? I mean, where do we sit? I mean, who do we now call a friend if you're going to turn around and do that to Europe?
Right.
I mean, you're obviously very plugged into geopolitical tensions because it's part of what affects your business as well. When you're thinking about global climate solutions, and you gave us some of the outlines of your plan there as well, there's some people that are going to think it's highly ironic that a mining company would be looking at a green transition.
I agree with them.
What green iron ore, what is that? Do these things really make a difference when it comes to the bottom line of limiting climate change?
Yeah, let's start with 3 million tonnes of carbon dioxide not going out into the atmosphere. I mean, let's just start there. And then let's realise that no one's ever going to make green iron or green steel, which is 10% of the carbon budget. Now we're talking huge, unless you start with green iron ore. So the fact we're going to green iron ore within a few years means that we can then go to green iron or green steel. Now that's starting to have a massive impact, because if we do that economically, then the pollution, which is currently suffered all over the world, particularly in China where they put their steel mills on the outskirts of their cities, central planned, but their cities grew so much bigger, so now the steel mills are inside the city. We send them totally pollution-free metal. Their pollution problem goes out the window. So there is a really big impact on this slow, lethargic, backward industry called mining, ironically leading the world to go green, and it's hitting where the pollution is worst. And it's not saying, oh, well, we've got to continue burning oil and gas because there's such lovely people and we have to look after them. We're saying, actually, oil and gas has got us into this manure. We've got to stop doing what we've always done if we want a different result, and switch off the oil and gas, and then we'll get a different result. And that's like green steel. That's like green shipping. Now,
what exactly, though, is green iron ore? And what does it cost versus other iron ore? And is it cost competitive?
Yeah, no, it's going to cost less, ma'am. It's going to, because
quickly?
we can make it for less.
Is it already?
Because we're not chopping through a billion litres of diesel here, like nearly 500 million gallons of diesel. We're not going to buy anymore, because we're making it ourselves. So,
is it cost competitive already?
Yeah, hell yeah.
Yeah.
Yeah. But that's the beauty of it, which is why I'm saying, listen, stop looking at going green. Stop looking at zero emissions as, oh, you're a really nice guy. What a lovely chief executive. What a lovely politician, thinking of the kids, not himself. Actually, get out of your hole. This is a great investment. You should be doing this for your shareholders. And if you say you can't go green, well, you're right. Get off the stage and let on someone smarter who can.
But why isn't everyone doing it if the case is that simple?
And done it sooner.
Because
it yesterday
everything starts somewhere, right?
Okay.
Everything starts somewhere. I mean, the suit you're wearing started with a thread, mate. It turned out to be a suit, so wear the thread.
Yeah. Talk to me about the conversations you're having here in New York as well. Are people getting the message?
People are getting the message. Yeah, I mean,
we look at the pullback on green agenda in so many parts of the world at the moment. We see it reflected in polling and in election results. Is that playing?
Yeah,
into
that's
the
an opportunity for us.
Okay,
that's a serious opportunity. I mean, we are pushing ahead, going green as quickly as possible. We've got technology which can take the water in here, so to steal your water bottle, turn it into the most powerful fuel the world's ever had, which is hydrogen. When we turn it from gas or liquid to really serious energy,
except you need
it goes back to water, right?
Yeah.
And we're working out how to produce that. It's not pure. We call it industrial hydrogen, but a fraction of the cost. Where we've worked out already how to charge cars, not in 22 hours or even 8 hours, but in 22 seconds. Okay, and these are the fastest electric cars in the world, like Formula E winners all the time. We've worked out how to charge our huge trucks in 24 minutes. You know, and I've had your US generals say to me, hey, look, you understand the US military can never go green. I said, why is that, mate? And they said, well, our tanks, they're 50, 60 tons, and they've got to go 50 mile an hour. And I said, well, hang on, mate, our trucks are 400 tons, and they've got to go 60 mile an hour. They're green. And they've said, well, you know, shipping, our warships are like 100 metres long, Andrew. I said, honestly, mate, we could put 3 of your warships on the back of our iron ore carriers. They're 330 metres long, and we're sending them green. So everyone can go green.
I am curious if you guys are going to be also building wind farms, solar farms right next to some of your mines to help supply green power. Like, is that part of the process?
Yeah, it is. It is, absolutely, and we'll supply power to us and power to others. Right now, we're operating a green grid. It's the first fully independent green grid in the world. It will be the largest, of course, because it'll be producing enough power the size of small countries, and it'll be a full grid, but it'll be off the standard grid, and that means that we can put this all over the world.
I want to come back to hydrogen because it's been talked about for many years. There's been a lot of money put behind it, yet to yield results. Where are the obstacles there? How far away is it from being something that's going to be widespread available and more heavily used as an energy form? Okay,
the only thing stopping the production of green hydrogen in North America, I mean, let's just remember that there's more people employed in the renewable energy sector in the fossil fuel old state of Texas than there are now is by fossil fuel. Yeah. So everything is changing. What we're seeing now is the whole growth, this massive growth of green hydrogen, green energy being held up by perfect getting in the road of the good in the IRA. And if we don't fix what a little thing called 45V, which is where the fossil fuel sector's got these environmental independent lobbyists to say, hey, look, we should have things like hourly matching. Well, okay, that's so perfect.
Parts of your own industry are working against this.
Yeah, I mean, but it's not my industry. It's the environmental lobbyists paid by fossil fuel. It's the same draw card, same playbook as tobacco use. They get so-called scientists in to say tobacco doesn't kill you, mate.
So it's money again, it's politics and it's lobbying.
Yeah, and we have to, Carroll, look straight through that and say to your legislators, and your legislators have got to say, actually, we're not going to let perfect kill off the good. We know green hydrogen is the answer. We will have weekly matching or monthly matching, but hourly matching just means the person who came up with that's never driven or operated anything more complex than a bloody computer, not these 1, 2, 3 mile long plants, which I have to operate.
So 30 seconds left. Are you more optimistic after your time here in New York and talking with global leaders, North American leaders, US leaders, or are you more pessimistic, just quickly?
No, I'm more optimistic.
About the shift?
Because they trust what someone does more than what someone says, and they can see we're doing it. They can see Australia's highest shareholder return company ever is going fully green, and there's got to be a reason for that, and they're making huge sales and they're profitable.
So we wanted to be smart and fun when you came in. Did we do it?
Yeah, you're smart and fun here. I love Bloomberg.
Such pressure. Andrew Forrest, thank you so much. Executive Chair, of course, of Fortescue, joining us right here on Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We are very global all this week here on Bloomberg Businessweek, and we've had this week the opportunity to focus on economic issues in different regions of the world and how the changing climate is altering many countries' trajectories. Well, the African Development Bank finances projects across the continent in areas including agriculture, energy, also the private sector development. And we know those African countries, something we talk about a lot here at Bloomberg, are among those most affected by climate change. So that is some of what we wanted to talk about here on Businessweek.
Yeah, indeed. And to discuss it, we're joined in the Interactive Broker studio by Dr. Akinwumi Adesina, who is the president of the African Development Bank. Thank you very much to see you. We've also got Bloomberg's chief Africa correspondent, Jennifer Zabasajja, with us in studio too to join the conversation. Dr. Adesina, welcome to New York. Great to have you here. You're here having conversations with global leaders for Climate Week and the UN General Assembly. What are you trying to get out of this week?
Well, first and foremost, is just to make sure Africa's issues are on the top of the agenda. Because when you talk about climate change, Africa only accounts for no more than 3% of total emissions, but actually suffers disproportionately from the negative consequences. It loses $7 to $15 billion a year. And if the current trend continues, that's going to rise to $50 billion a year. But it's not getting the amount of financing that it needs. Africa needs roughly about $277 billion a year to tackle climate change, but it gets no more than $30 billion. So there's a big gap there. But most of what is needed there is really to adapt to climate change. It's not so much on mitigation, but it's about adapting to climate change. The other thing that I wanted to get out of most of this is actually how we tackle Africa's debt issues, because at the end of the day, you can't run up a hill if you're carrying a backpack of sand. And so you can't have development in which you have highly indebted countries. And so we have to make sure that African countries facing a lot of challenges in terms of climate, in terms of also conflict, also in terms of high inflation and strengthening fiscal space, that they have the space they need to be able to invest in education, health, water sanitation, girls' education, and all of those things. So debt, climate, for me, are very, very, very important part of my conversation here this week.
And Dr. Adesina, I mean, part of that, I want to start with climate change maybe because you have talked a lot about, in particular, the IMF special drawing rights and channeling more of those towards addressing climate change on the continent. Where is the progress on that? Did you make any progress this week while here in New York?
Well, actually, just to think about the special drawing rights of the IMF, when we started, everybody thought, well, SDRs were things you put on the balance sheet, essentially as reserve assets of central banks. But we felt that actually these assets were actually simply latent assets, that I was convinced that we can actually do better in terms of seeing how we can turn those into assets that can unlock a lot of capital through the multilateral development banks. And the model that we developed basically was to say, okay, if you actually rechannel the SDRs to us as AAA rated financial institutions, that's actually a hybrid capital that we can use. And it's a perpetual thing that stays on our balance sheet. So we can actually leverage that 4 times. It can even go to 4 to 8 times. And so we're very delighted, myself and the president of Inter-American Development Bank, we worked together very collaboratively to solve some of the because there were some technical issues about what's the reserve asset status of it. And if you want to collect it back, how can you get it back? So we had to deal with some technical issues. We solved all those technical issues, and I was delighted that the IMF board actually approved $20 billion of SDRs to be rechanneled through the multilateral development banks as hybrid capital. Now the issue is how do we get that money out? Yeah. So to get all that money out,
how do you?
Yeah, exactly. We had to actually put together a group of 5. We need 5 SDR-rich countries that will agree to rechannel that through the African Development Bank and the Inter-American Development Bank. But also we have to make sure we have a group of others that are in Europe. For example, European countries can't do it because of restrictions by the European Central Bank on monetary policy outside of the EU. And so, but we set up a very nifty structure, which is called Liquidity Support Agreement, in which they can just essentially guarantee those that are giving it to you. Okay, that's still allowed. So that's where we are. We're making progress in terms of the countries. We're talking to them. And I'm hoping that, by the time we do G20, we'll have gone a long way in making sure that's realized.
Long way, or will you actually have access to the funds?
Well, actually, the long way is to get access to the funds. So which means there has to be agreement. It's not just easy. Just like I gave it to you, there are legal things they have to go through in their countries to make sure that gets done. So we know that President Lula, as the presidency of the G20, as I spoke at this event just yesterday, that the SDRs used, for hybrid capital and getting it out to us is top on the agenda for G20.
This is something that, we're deep in the weeds of international financial machinery here and how the money gets reallocated.
That's what we like to do, educate the public.
This is something, I was at the EU Africa Summit 2.5 years ago when this idea was sort of advanced to a level where the reallocation would be able to happen. The political will was there from under Emmanuel Macron at the time. Is the political will still there to action this and to make sure that transmission happens as quickly as possible?
Well, remember there are 2 things we're talking about here. That is the one in which there was a request to make sure that some amount of money actually given, through the IMF, through its poverty reduction and growth trust and resilience and sustainability trust. So that's money that's being given to IMF. Yeah. That's a different thing. The one that I'm talking about, and that's going very well. I think they have probably the $100 billion they're looking for of SDR. The one we're looking for is how the SDRs gets rechanneled through the multilateral development bank, so we can actually leverage that. The thing is that when the money goes to IMF is very, very great. Kristalina, my sister, has been enormously helpful. But for us, it's a 1 to 4 thing. Every dollar becomes 4. It's good for you as a shareholder. It's good for the taxpayers, and you don't lose all the money. And so the progress has been made. This phenomenal progress has been made. But I think we just have to tie the knots and make sure the money actually comes home, and we can continue to do it. I'll just tell you one thing that I can do. I take the case of, RJ Banga, president of the World Bank, and I got together during the spring meeting, and we said, look, we still have 600 million Africans that don't have access to electricity. Right. That doesn't make any sense. You can't grow in the dark, you can't industrialize in the dark, and you cannot be competitive without electricity. So I said, we're going to have to deal with it. And so we both agreed, and we launched what's called Mission 300, which is to connect 300 million Africans to electricity by 2030. Now, universal access to electricity in Africa is going to require $190 billion per year. Now, here's where the SDR connection comes in. Mm-hmm. Because if you actually have $50 billion of SDRs, and you can leverage it at 4 times because it's a hybrid capital for you, that means that problem is solved once and for all. That is $200 billion at least to solve that problem. So that's the connection that we are trying to make. And President Lula, as president of the G20, is also we've raised the issue also about he has something called the Global Alliance Against Poverty and Hunger. Okay, and so it's the same thing. You use this SDR as well. You unlock massive amount of capital to deal with all the things we say we have a pact of the future.
So you think that within 6 months, 12 months, you have that capital that you can move forward? I
believe that we will, because I think that the most difficult part, we've gone over that. Okay. So it's a question now of how we're going to use it and how we can get it out. So I think so, yes, absolutely, yeah.
Well, one of the other things, I'm just curious about other parts of the world where you look to access, partnerships money. You guys have been working with the Arab Bank for Economic Development on some key projects. What can you tell us about further expansion there? We're also curious about, the relationship with China and money coming in from China. What can you tell us in those 2 aspects?
The Arab Bank for Economic Development in Africa is a very great partner of the African Development Bank, and we have joint projects that we do together. Will you do more? Oh yeah, we will do more, and we work in education, in water, in sanitation, in agriculture, and infrastructure, and so on. And so they just celebrated their 50th anniversary. I was one of their keynote speakers to speak there. They've also invested in one of the things that we put up called the Alliance for Green Infrastructure in Africa, which is a vehicle that we just put together to mobilize $10 billion of private capital going into greening the infrastructure space, greening the green transport, green hydrogen, green ammonia, and also making sure that we can basically have climate resilient infrastructure all across Africa. So we have a lot together. We've done, together about almost $835 million of joint projects in the last 7 years, and we've put in $600 million into that. So we are great partners, and I look forward to us doing more together.
What about China? Yeah, which we know over the years we've talked about the investments China has done. Yeah. Some of it, they're concerned about their access certainly to raw materials, basic minerals, and so on. So what can you tell us on that front?
Well, I think China invests quite a lot in infrastructure in Africa, and people get to ask me a lot of questions about that. But the question really is that Africa's infrastructure gap is so massive. Africa needs at least $60 to $108 billion a year. Not to talk of even the challenges you have. You're doing the infrastructure, and all of a sudden you have all these cyclones and hurricanes and all these things that are happening. That's actually setting you back, right? And so, but I think that what has happened is on the infrastructure space, what I just note more generally is a lot being done by governments. And I don't think that infrastructure should always be carried by governments. I think you need to have a lot more private capital moving into infrastructure. Right. I think you have to make sure that the debt burdens from infrastructure are reduced. I also think it's very, very important to make sure that the infrastructure being done, in any case, should be infrastructure that you can recycle. In other words, governments, if you've actually taken a lot of loans to do infrastructure, why not just do asset recycling? Basically, just recycle that into private sector and then free up more capital to be able to do more. Right. And so that's how I look at it. And I think that for us at African Development Bank, in the last 7 years or so, we've put in more than $55 billion into Africa. We are the largest by far multilateral financial institution investing in infrastructure.
Right. When you talk to international investors, Dr. Adesina, I know you were meeting with a few of them while you were here this week. I mean, what is their concern? Because we hear a lot about risk in investing potentially in a lot of these infrastructure projects that you're talking about. I mean, what is it that international investors are hoping to see in order to penetrate more into more of these markets?
Yeah, if you take a look at it, we don't get that much of private capital moving into infrastructure, right, in Africa. But the issue is, people talk about risk. Well, life is about risk return. People forget about the return part of that. And so it's a risk-return world. And I take a look at Africa, and I don't think Africa is riskier than any other part of the world. Don't believe me, just believe the data. There was an assessment that was done by Moody's Analytics, who looked at the cumulative losses on infrastructure financing globally, not just in Africa. And what did they find? They look at 14 years of non-performing loans and debt, and they found that in Africa, the non-performing loans was 1.9%. In North America, it was 6.6%. In Latin America, it was about 10%, and in Eastern Europe, about 12.4%, and Western Asia almost 4.5%. So Africa is not as risky as people say. Perception is not reality.
How do we change that perception? Because I think you've got this really smart global audience right now, and I think we think of emerging world and we think, oh yeah, Africa. What's the message you would like to get out to the audience who's listening right now?
Well, first and foremost is that the fact that I said it's about risk return, well, doesn't mean there are no risks. Right. So first and foremost is that we have the vehicles to de-risk those things. So we have project risk, market risk, and whether there are also political risk insurance that we can actually provide. In fact, the African development.
Some say we have a little political risk too, but go ahead. Continue.
But we can de-risk that. So I'll stay within my lane. But we're trying to put all of our instruments, so partial risk guarantee instruments, partial credit guarantee instruments that we do for counterparties, whether government or private sector. We're trying to pull all that together into what we call an African insurance and guarantee agency. So private sector needing those risk instruments don't have to run in everywhere to lower their transaction costs to do it. And that will be a game changer, because it will also provide insurance against equity investments. It will provide insurance for you when you actually also have political insurance, and insure you against climate shocks. And the last thing I'll say about this particular thing is just that when investors are looking to invest, they're asking the question, where are the bankable projects? Right? You have to be able to have a whole series of bankable projects. And we're doing very well on that. We have, for example, an institution that I actually chair its board. It's called Africa 50. It's a private equity vehicle that has about now $1.1 billion and portfolios of $8 billion on infrastructure assets. Wow. And basically what it does is, it's as a part of a company, it's called Project Development Company. And so it develops bankable projects that it can sell, right? It doesn't matter what it is. So we're trying to make project development a business issue, not just a development issue.
It's the financial, the private sector involvement, right?
That's right. And the last thing I'll just say about investing in infrastructure, it's the importance of local currency financing. We talk about debt just now, but if you actually look at the assets that people are investing in, the revenue streams are going to be coming in local currencies, and the currencies are actually depreciating very much. So local currency bonds are going to be very important for financing that, and also synthetic local currency instruments are going to be there, and as well as, we at the bank, we support financial institutions in Africa that actually lend in local currency, but we actually insure you. We give you the risk. You lend it, and we bear the risk ourselves. Right.
We're seeing a lot of that volatility with currencies all over the continent. Dr. Adesina, we were just talking briefly about how this is your last UNGA as president of the African Development Bank. I wonder how you think about your time in office over the past decade or so. You talked about how the bank looks a lot differently than how you inherited it. I mean, how would you assess it?
Well, first and foremost, it's the greatest honor of my life to be asked by shareholders. We've got 81 shareholders to go, and actually you have the resources, you have the confidence, you have the support, and guess what? Go change the continent of my birth. And that's not for me a job, that is a mission. I take it as a mission. And so that's how I look at it every single day. Now look at what has happened to the bank since we actually started. For example, when we started, I said that we have to have a clarity about how the bank tackles issues, day-to-day issues of people. People shouldn't really looking at, you have African Development Bank. The issue for me is not just the bank. We know how to run the bank. It's the issue is the development part, right? And so we actually set out to actually say 5 priorities for Africa: light up and power Africa, universal access to electricity, feed Africa, integrate Africa infrastructure-wise, industrialize Africa so Africa can be competitive with global value chains, okay, and increase its share of global manufacturing. And then, of course, improve the quality of life of the people of Africa, the things that we all care about: water, sanitation, education, skills, jobs for young people, and all of that. So we, in the last since the last 7 years, that work has impacted on more than 400 million people. And second is what we've done in terms of raising more capital for the bank. When I was elected president first at the bank, my first term, the capital of the bank was $93 billion. Today, the capital of the bank is $318 billion.
It's a big difference.
And last year, just one point here, last year, the African Development Bank was ranked as the best multilateral financial institution in the world. And last year and this year, we were ranked also as the most transparent financial institution in the world. So I think that we've done pretty well. I think my staff have been fantastic, but most importantly, my shareholders have just been phenomenal. When I was reelected, with 100% of the votes, so which was fantastic.
Well, it's certainly a part of the world that we focus on so much. Jen knows this as she spent so much time on it as well. Dr. Adesina, thank you so much.
Oh, no.
Thank you for finding time for us. Jen Zabasajja, thank you as well for joining us and on this conversation. That's going to do it. Of course, the president of the Africa Development Bank.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, we've got just 18 minutes to go for the Thursday trading session. Charlie breaking down the numbers. We're kind of bouncing around a little bit off our best levels of the session when you look at all of the major equity averages. We're wondering whether or not we see another record on the S&P 500. Didn't happen yesterday, but could it possibly happen today? So let's get to it with the markets. It does feel like we're almost in this. Do you guys ever feel that, like over in London, like sometimes we're going from Fed to Fed meeting, or we're going from earnings season to earnings season?
Yeah, basically. It's right? like, and this is, we're in the in-between.
It's exactly right. We're just kind of waiting for some direction. Let's see what Brooke May has to say about all of it. She's managing partner at the independent advisory firm Evans May Wealth. They've got $1.4 billion in assets under management. She joins us from Carmel, Indiana. Is it Carmel or Carmel?
It's Carmel.
Carmel. Okay. I had a feeling I might have said it wrong.
You're not alone.
Having been to Carmel in California. But hey, tell us about what's top of mind for folks in that part of the world. I love it when we talk to people that aren't necessarily on one of the major coasts, but tell us what's top of mind when it comes to the economy, when it comes to the investing environment. Just kind of set the scene for us.
Yeah, right now, clients are concerned about the elevated levels in the market. When you ask our investors, they feel pretty good about their personal situation. However, they're concerned about the broad economy. And so as we navigate that, we're looking at earnings and we're trying to figure out what's the right level for the market to be trading at. Our year-end price target was 5,600 to 5,800, and we're there a little earlier than expected. But we think the market could go higher. When you look at the amount of cash on the sidelines, there's about $6 trillion sitting in cash and money markets. While we don't think all of that would flow back into the market, about $1 trillion went into money markets in 2023 alone. So if people didn't buy corporate bonds at 5% a year ago, are they going to buy them at 3.5%? We think that could be another tailwind in addition to earnings growth.
So, what's going to motivate that money off the sidelines, though? If we're looking at the S&P potentially heading for a 42nd record close this year, what's going to do better that's going to motivate that money out of cash?
Mm-hmm. Well, I think that they'll be pushed out by lower money market rates in looking for higher earning alternatives. And while they might not get that in the very near term, over time, they're going to make more in equities than they would sitting in a money market or in cash.
All right. So then, having said that, someone comes to you with some new investment money. Where do they put it in your view? And it is, Steve and I kind of kicked it off saying we're in this interesting, time period, right? We just got through a major Fed meeting. We wait for the next one. We're getting ready for earnings to really kick off. So do you say wait and hold? We've got elections just around the corner. What do you say?
We're dollar cost averaging over the next year for new money. Our clients who are invested, we're staying invested. It's difficult to time the market, but at these elevated levels and the fact that when you look at earnings relative to where the market is, we feel like we're fully priced in right now. So we're not getting out of the market, but for new money, we're dollar cost averaging in, and we're doing it over the next year.
When we're thinking about earnings season and the sort of signals we're going to start getting from the big companies now about what comes towards the end of the year, what are the key things that you're watching out for? Where are you digging into the detail?
We're looking at revenues. Companies in this challenging environment have been able to maintain their profit margins. It's been impressive. But at this point, if we see the value trade where people are looking more for value, there's some compression there. And so we want to see companies grow their revenues. When we look at this last earnings season, 79% of companies beat on earnings, which is well above the historical average, but only 60% of companies beat on revenue. So clearly there's some concern there, and that's one of the factors that we're going to be looking at going forward.
Do you like big tech still, though?
We do. We also like the broad market, though. When you look at going into 2024, the earnings growth expectation for big tech was 28%. And the other 493 names, earnings were only expected to be up about 7%. Going into 2025, we think big tech earnings will be up 17 to 18%, but the rest of the market to be up about 13%. So we're seeing a broadening in participation. Corporate earnings are healthy right now. And when you talk to CEOs, their outlook is stable. They think that wages will be up a little over 3% over the next year. They think that hiring will be stable. And when you listen to those earnings calls, the word inflation was only mentioned on about 50% of the time. So we think that really the CEO sentiment is relatively stable, and they're the ones that are doing the hiring and firing.
What about those companies that are most exposed
for the economy?
What are those companies that are most exposed to the consumer as well? Because, there was a time when we were a little bit worried about some of the credit card data and a couple of signals in the beige book about, some consumer bumps to come. They haven't really materialized yet. What's your view?
I agree. Unfortunately, there's a bifurcation right now, though, in the environment where lower income households are really being squeezed. However, middle America and really the high-end consumer haven't struggled nearly as much. They're looking at their 401k balances and they're at all-time highs. They feel good about the value in their house. And so really, it's a tale of really two cities. When we look at default rates, for example, it's in the subprime area, specifically, mostly in low income. So there are pockets of the economy that are struggling, but when you look at the broad economy, it's relatively healthy. Unemployment's at 4.2%. Granted, that's well above the sub 3.9% we saw for 2 years.
Right.
But when you compare it to an historical average, it's really low. And we don't see it ticking up much more. With Fed rate cuts coming, that's going to bode well. And we think that unemployment is going to be relatively stable.
Hey, Brooke, just got about 45 seconds left here. One of the most read stories on the Bloomberg is an exclusive. It's about Citigroup and Apollo Global Management teaming up in the fast-growing credit private market. They're going to work together on $25 billion worth of deals over the next 5 years. Private credit. You are dealing with, I'm assuming, higher or high net worth individuals. How much do they want to be in kind of the alternative investment space? And again, just got about 30 seconds left here.
Yeah, it's a new entry point for us. Over the last few years, private credit has become a buzzword, and most of the mutual fund and investment firms that we're talking to are talking to us about private credit. So there's growing demand there. Yields are very attractive, and whenever the economy is this strong, the default risk isn't what it would be in a struggling economy.
All right, going to leave it on that note. Listen, so appreciate it. Take care. Enjoy the rest of the week. Brooke May, managing partner at Evans May Wealth. They're an independent advisory firm. They've got $1.4 billion in assets.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.